And there we are. Good evening, everybody. Welcome to a kind of, I guess, a special edition of Tuesday Night Live. We actually have a particular topic was asked about, received some questions on Trump's big, beautiful budget bill. So I was curious about it myself, some details and some of the different estimations. So started looking into it and ended up being a fair amount of time. So just decided to go ahead and just dedicate the whole show to it. I'm Clay, joined here tonight by the lovely and gracious E-Train, broadcasting from one of our remote locations.
There you go.
So we are glad to be with you tonight. Hope everybody's had a good start to the weekend, to the week. I'll get it right in a minute.
That's all right.
Yeah, in the summers, my calendar, I should say, gets a little wonky. Gets sometimes a little hard to remember exactly what day of the week it is. So for good or for bad, I do enjoy it, but not always the best at remembering what day it is. But we're glad to be with you tonight. Hope you've had a good start to the week.
Absolutely.
Tonight, I'm just sitting here thinking, tonight we're going to be kind of taking a little bit of a deep dive into one of the most talked about, tweeted about, and maybe tear your hair out pieces of legislation this year. The president's big, beautiful bill.
Ugh.
What?
I hate omnibus bills. I just think it's a bad idea altogether, but that's just me.
Well, the funny thing is, that's actually the name of the bill. That's not just a euphemism. That is actually the name of the bill. Hello, Jane. Hello, everyone. It's a long day at work today, but at least I got outside to plant my echinacea.
Nice.
Glad to see things are warming up and getting a little prettier up there. It has been pretty down here. We've had some rain, but we needed it. And but glad to see you're able to get out and putter around in the garden. I actually missed that.
Yeah, touch grass. Do the things.
I'm a little jealous. Though I have been touching some sand, so that's probably not a bad trade-off.
No.
Raining buckets, but the sun came out this afternoon.
Excellent.
Yeah, we've had some rain the past couple of days. I guess it's headed north towards you, but we needed it. We've been a little dry. So
we've had it. Yeah, we've had it where I am for the past week. It just has not stopped. I sent Clay a picture of the clouds. Was that Saturday night?
Yeah.
And it didn't stop raining until early this afternoon.
And the funny thing is, I live on an island separated by a river, separated by the ICW, and then there's a river that backs it up. And I can't tell you how many times I have seen strong storms come from the west to the east and hit that river and then bounce northward and not cross the river. So there's a lot of times when in town, just across the river, the ICW, they'll be getting rain. It won't cross. We won't get any.
Oh, I remember coming back to the island and it was hailing and pouring down rain. And I sent Clay a picture and he's like, it's sunny. It's lovely here. Yeah. I'm like, you're not that far away.
You hit that bridge, you cross that bridge, and it's a whole different environment. I don't know the exact dynamics of it, but I've just seen it for years. And we don't get a lot of the rain that they get, just across the river.
Mm-hmm.
I love the rain, but it does delay my planning schedule. Well, at least you've got a planning schedule. I don't want to hear it. Wish I had one.
True. You'll get there.
I'll get there. Working on it. But yeah, I look forward to shifting gears somewhat. All right. The big, beautiful bill.
There you go.
Come up and I'll put you to work. Having work to do is not my problem.
No, it's not.
I have got plenty and have been backed up out the wazoo, actually.
True. And I'm going to, of course, be a turd and say, Clay, can you make that a slide full screen?
No, I cannot.
Oh, I thought you had before.
I lost my second screen monitor.
Oh.
So
there's one upstairs.
I am running multiple things off of one screen. It's a little tricky.
Use the one upstairs.
Which one upstairs?
In my closet.
Oh no, that's way too big. That's a TV.
It's still a screen.
Yeah. Well, can't do it now. This one just went out today.
Oh, I know. Oh, geez.
Oh.
Okay.
Yeah. So that's a little irritating. So no, I can't blow the screen up any bigger. Sorry about that.
It's all right.
Because I couldn't see anything else.
Got it.
And couldn't switch the slides.
Gotcha.
So, all right. Big, beautiful bill. One of the most talked about and argued about, really talking is putting it mildly, argued about bills that I've ever seen. From most any administration. Well, since Obamacare, maybe. But it's attracted a lot of attention. Now, it's really kind of a game changer for the economy. It promises everything from tax cuts to deficit reduction, boosting GDP. And, but as with any major policy proposal, the devil is always in the details. Or should I say the estimates. And there have been some wide-ranging estimates, proposed on this bill. So tonight, thought we would take, a little time, dissect some of these estimates, look at the underlying assumptions, and just give them a critical eye. We'll talk about GDP growth. We'll talk about inflation rates. We'll talk about tax revenues. And yes, we'll even mention the tariffs. So I hope those things all sound exciting to you.
They do.
Yeah, and I realize, I love what I do. I love this field. This stuff is of interest to me. And I realize to a lot of people, it may not be that terribly exciting or dramatic, but this is the kind of stuff that impacts your life, that actually impacts your life, your future, your economic future, some of your opportunities, oftentimes your housing. And so in that regard, it is important. I think it's important that people know and understand. So hopefully tonight will help in that endeavor. I'll also throw out some questions for you to ponder along the way. So grab your financial calculators, your notepad, your skepticism, maybe a nice little glass of scotch, because we're in for a ride. Now, depending on where you are politically, where you sit politically, this bill is either kind of a second shot at a Reagan-esque supply side revival or a fiscal firestorm in MAGA wrapping paper, or it's just a PR missile aimed at Washington while the economy sits and smolders. So our goal tonight is basically we're going to try to sift through all the hype, the hopes, the dreams, whatever. Take a look at what economic havoc this might wreck, but realistically try to take a look at what the bill actually does, what it costs, and who it might hurt or help. So let's start with what's in the box. The bill is not a small bill. It's 1,038 pages. And what you see is the first act with the title. And if you'll notice, section 1.2, the act may be cited as the one big, beautiful act. So that still kind of cracks me up. But it is technically titled HR 1.
So that'd be House Resolution 1.
Yes, House Resolution 1. So the bill in brief, it lists across the board income and corporate tax cuts. It reinstates the salt deductions up to $60,000, salt, state and local tax deductions. In the 2017 Act, those were reduced to $10,000. Well, this bill will expand those to 60. This was kind of a compromise to try to win some New York State Republican votes. New York, Michigan. It's another state. It's not California. But anyway, it eliminates clean energy tax credits. Even the tax credits on Tesla. People talk about how Musk was doing what he was doing because he could influence legislation and have things structured to favor him. This doesn't favor him.
Nope.
It also has an interesting proposal we'll talk about a little bit. The introduction of what's known as MAGA child savings accounts. So we'll take a look at that. That'll be of interest to you, particularly if you are considering giving birth. It also has grandchildren. It also has massive projected tariff revenue, roughly $2.5 trillion over 10 years. That's pretty damn significant. And one thing most people aren't aware of, it contains pretty deep budget cuts to federal agencies, programs, regulatory enforcement, and social programs like Medicare, Medicaid. Now, some people have been arguing or saying or implying that it cuts benefits. It does not. What it does is cut fraud and waste. It doesn't change anybody's benefits if they're legally entitled to receive them. But we'll talk about that some more as we go along. Now, you're probably asking, how much does all this cost, and what do we get for it? That's a good question. Now, there are a number of different estimates out there.
Okay, now quickly, before you get into this, I had so many questions about this CBO thing. And why does it exist? And what is going on? What does it mean? So Clay broke this down for me personally in a conversation last week. Is that correct?
Yes.
So, because to me, it was very confusing.
The CBO is the Congressional Budget Office. And it's billed as a nonpartisan accounting office run by Congress, overseen by Congress. But the simple fact is that it has always been relatively partisan, for good or for bad. I mean, we all have our biases. We all have our beliefs. And particularly in economics, when you're trying to estimate future impact of economic action, ideas, whatever, that's where your ideology or your theory comes into play. And the CBO has been dominated by, people who have certain views. Okay, fair enough. I just don't consider it to be terribly neutral on issues. And we'll look at it. But the CBO came out with an estimate, and they said that the big beautiful bill will add $2.4 trillion to the deficit. Yeah. And people took that number and ran with it. What these people don't do is look at the underlying assumptions. And I always tell my students, I hate bottom line people. If you've known somebody that says, I'm a bottom line person, I'm kind of like, well, how do you tell everybody you're an idiot without telling everybody you're an idiot? You don't need any brains to read the bottom line. Hence my picture selection for this slide. If y'all don't know that, that's Jim Carrey,
I know, right?
in Dumb and Dumber. And the guy plays an idiot pretty well. But anyway, he could be an economist. But looking at the underlying assumptions is where you make your money in business, being able to change or impact those underlying issues which influence the bottom line. So in an estimate or projection, the underlying assumptions are everything. It's not the bottom line, it's the underlying assumptions. And look at the CBOs, for example. They estimate GDP will be 1.5%. 1.5% is extremely low. That takes us back to Obama. Remember 6 months before the election, he was mocking Trump's talking about improving the economy. Obama was talking about the new normal, 1.5% GDP, 1 or 1.5% GDP. He was saying that's the best you're going to get. That's what you got to get used to. That's the new normal. His term, not mine, his term. And he asked, what did Trump have? A magic wand? Well, we all, pretty much know what happens. Trump gets in office, cuts regulations, cuts taxes, the economy takes off. So 1.5% is extremely low. And that has a big impact on the revenue, the tax collections. They state there will be moderate inflation, 3-ish%. And importantly, all three of these are important, but they ignore completely any tariff revenue. And with the amount that has been collected or will be collected, that's a significant oversight. So when they say it adds 2.4 trillion, what they're basically saying is, okay, it'll be this number if you don't include all this revenue. Does that make sense? Does that really sound impartial? Brookings, Yale got together and came up with a projection that their main conclusion, and I'm going to try not to give you too many details, but they came up with basically the bottom line is it will slow long run growth, which I find fascinating. I don't know if they're oblivious to history or economics or both at the same time, but slowing long run growth, that's a fascinating conclusion. The Tax Foundation is one that's widely cited. Brookings and Yale, almost nobody's citing. Okay. I mean, even stupid people realize gross stupidity when they see it. Tax Foundation estimates basically $4 trillion in revenue reduction over the next 10 years. That's a pretty significant chunk of revenue reduction. They also estimate that the bill will increase GDP by only 0.8%. So pretty much stagnant GDP, slight growth. Inflation they hold as stable, 2.5%, 3%. And they also do not include tariff income. So they have a net deficit increase of 2.6 trillion. That's interesting. Remember, the White House is estimating 2.5 trillion in tariffs. So if you include the tariff income, it using the Tax Foundation's estimates, which I think are sketchy,
Mm-hmm.
the deficit goes away. Trump's team has their own estimates, obviously, and they say tariffs will pay for everything and more. It'll reduce deficits by 6.6 trillion over the next decade.
That's a lot of money.
That's a lot of money. They assume a 3% GDP. Revenue, if that occurs, revenue increases by $4 trillion. Just tax increase, just income taxes, corporate taxes increase by $4 trillion over the next decade. Everybody's projections over 10 years. They also assume inflation will be very low, stable prices, and there'll be an additional 1.7 trillion in permanent savings in mandatory spending.
Now, I have a hard time believing that.
Yeah, I was going to say my only hesitation with that is that most of those savings come in several years through the end of the 10 years. And we all have seen Congress promise to cut budgets and then not cut them. So
exactly, because this lays in the hand of Congress, and whatever they have decided they're already going to spend, they're going to continue to spend it. They're not going to reduce their own costs, even if they don't even need the money. They're going to keep it. And it's like, how, if we can't pay our bills, our debt as it is, it seems a little like we've been saying.
Yeah, a big key is going to be the midterms.
Yeah.
Who gets elected? Just a handful of votes in the Senate, handful of votes in the House will swing it either way. Could end up with a Congress that actually will cut some spending, or one that will absolutely fight it tooth and nail.
Right.
So that is yet to be determined.
Yeah.
The other group to consider is the Council of Economic Advisors. And they predict a GDP boost of about 5.2%, which is a pretty strong boost. And this is just simply a function or extension of the Laffer curve. Now, if you're not familiar with the Laffer curve, it's a concave function. Concave function. It's a big upside down U. A graph, a upside down U.
It's a convex then.
No, right? It's concave.
That means it goes this way.
U. Yes. The way to remember it, let me do this. See if this works. I don't have a fat marker. Can you see that? Okay, that looks like a bear cave. Concave.
I thought it was the opposite. Okay.
Hold on. Concave. Not a bear cave. Convex.
Gotcha.
Concave, convex.
Okay.
Does that help?
Yeah, because I was thinking cave as like a hole.
Yeah. Cave is like a hole.
Other way. No, I mean a hole, like a hole in the bottom of the sea.
No.
There's a hole. Sorry.
So concave.
I won't get you started on that tonight.
Yeah. Concave is like a bear cave. Convex is not a bear cave.
Okay.
So and Laffer came up with that curve, not the function, but using it in an economic sense to show the relationship between tax rates and tax collected. There is in this function, come on now, there you go. There is in this function a peak where rates collect the maximum amount of taxes. But if you raise rates higher than that peak, whatever that peak is, taxes fall. The revenue collected fall. Because
so that is revenue versus tax rate.
Rate, yes.
Okay.
And there's a maximum amount of revenue collected at some rate. If you go past that rate, the actual revenues collected will fall.
Okay.
So that's a simple theoretical construct.
I get it now. Okay.
And called the Laffer curve. And he, some people kind of mocked him when he first came out with it. But now it's accepted widely. People still don't know exactly what that rate is.
Right.
Because it depends on so many different factors.
Yeah, even Senator Ron Johnson talked about it. He's from Wisconsin, which I just found out. He was talking about the Laffer curve. And like you can't tax. You just can't raise it to whatever point because you'll get nothing eventually.
Yeah. You can look at France. They implemented a millionaire's tax. And millionaires left France and their tax collections collapsed. Same thing happened in, was it the Netherlands? I think I used that example last week about how they, increased tax rates and their collections actually fell. So, yeah, there are, millionaires are mobile. They can
go wherever
take
they want to
money and go.
And they will.
And they will. And if they take their money and go, then poor people have no jobs because hate them or love them, millionaires are the ones with the money that pay for new jobs, create new companies, invest in and start up new companies. And that's where you get your job creation from. It's not these big old conglomerates. Hell, most of those are laying off. I just saw where Amazon announced it was laying off 10,000 workers. Going to go
think about
robots.
Yeah, think about how many people, even I don't care if you hate him, Elon Musk has created so many companies, employed so many people in the United States because he had ideas and he had the money to employ them and create the businesses and do the things. He's a perfect example of what the U.S. needs more of, in my opinion.
There were times when Tesla or SpaceX was about to go bankrupt and Musk was dumping in some of his last money, in the early 2000s. He very easily could be a street bum now if those hadn't worked out. But he had
taxed him out of business.
Yeah, if taxes were far higher. If you want to understand economic theory, just personalize it. you've got $1 million in a retirement account and you're thinking of, or $100,000 in a retirement account, and you're thinking of starting a business. Are you more apt to start it if the taxes on that business are 50% or 10%?
10.
I mean, the higher the tax rate, the more money you have to have. Taxes are an expense to the company. They have to raise prices to pay for the taxes. That's what most people don't understand. Corporations don't pay taxes. I'll say it again. Corporations do not pay taxes.
Can you explain that? Because so many people don't understand that concept.
They collect them. Taxes are just like rent, labor, raw material cost. The higher those costs go, the higher price they have to charge, because they need a return on their money, on their investment. If they don't earn a return on that investment, investors take their money and go elsewhere. So they lose their capital. And you would too. That's why you buy stocks. That's why you invest. You expect a return on your money. And you have a choice between a company with, a very low return, company very high return. The risks are similar. You're going to choose the one with the better future. The one you think has a better future. How many people want to invest in a company that is going to make less money next year than it does this year?
I don't.
I've asked people that for decades, and I've yet to find one person that says, yes, that's the kind of company I want to invest in.
Okay, let me ask you this real quick.
Yeah.
Okay, go ahead. Finish that thought.
Companies, I remember people kind of getting mad because Exxon was reporting record profits years ago. Well, again, every year a company should be making record profits, unless you want to invest in a company that makes less next year than it makes this year. So I hope every company I invest in makes record profits every year. I cheer them. They're going to keep my investment. Okay, your question?
Do corporations pay income tax?
No.
They pay? Hang on. I'm trying to simplify it a little bit.
Okay.
They pay employment tax, correct?
Yes.
Okay. They pay, what else do they pay? Or they pay their sales tax they have to pay from what they collect.
Yes. Well, they pay taxes, for employees. They have to pay FICA taxes.
Right.
They have to pay excise taxes. They have to pay state taxes. They have to pay licensing fees. They have to pay, depending on the industry, and those fees can be relatively steep. It can be annual.
Right. Okay.
So it just really depends on the industry and the state they're in. But
just want that to be clear.
Yeah, if they're profitable, they have to pay the corporate income tax rate. And whatever those taxes, whatever those fees are, they are all, every one of them is an expense to the company.
Correct.
And as such, the company has to pass that charge on to the consumer. And so the higher the taxes are, the more they have to charge the consumer, the higher their sales price, which makes them less competitive against other international companies that are in nations with lower taxes. That's one reason why, and wages. That's one reason why you see so many products made in China and Taiwan, Vietnam, India. They have much lower regulatory and tax cost than the U.S. does. So that has made it difficult for firms to compete, U.S. firms to compete nationally as well as internationally. So, was talking about GDP growth. And I think you can see how that underlying estimate ends up making a massive change in the projected outcome of the big, beautiful bill. So GDP growth is significant, hugely significant. And that doesn't even include the rescissions package that the administration is putting together. Rescissions, the spending cuts. They're coming up with a separate spending cut bill.
Can they do that after they already pass the spending bill and then go back and take it back? Because I was told they couldn't.
No, they can. The thing in this is a Reconciliation Act, and they can't actually address spending cuts in discretionary spending cuts in it. They can only do mandatory.
Okay.
And so part of the, I guess, incentive for this bill is that, at least in Republican eyes, is that it has Homeland Security increases for Homeland Security and for defense.
Mm-hmm.
So once they're approved, that won't have to be in the other budget bill that addresses other spending cuts, and it can't be used as a trade-off or a negotiating technique by the other side.
Okay. What about all the excess money that's going to certain organizations that they have to spend that's obviously overspending and throwing money away? I think you know what I mean.
Yeah, the discretionary spending.
Yeah,
this bill doesn't address that yet.
But that's going to be in the
budget bill.
Follow-up
bill. Okay. Package. Yeah.
Okay.
So, anybody have any questions? Do you believe Trump's bill will help or hurt the economy? I'm curious as to your thoughts. Do you think it'll boost growth? Do you think it'll spur inflation, or both? Or neither? Do you think it's just, a lot of the discussion on it is just political optics? So
I think it's, if you're asking me, I think it could go either way at this point. It's kind of a crapshoot. Depending upon the follow-up bills, if they get passed.
That is not an insignificant consideration. I want to kind of try to isolate this bill, its impact, but the practical reality is that's not practical. Because a whole lot of what occurs or happens over the next 10 years is going to be determined by some of the spending cuts they're able to get passed this year and next year. So it really does not operate in a vacuum, and you can't single it out. You shouldn't single it out as a vacuum.
No.
I know some of the opponents want greater spending cuts in this bill. And while I would love to see that personally, I realize that you've got to have votes. And so if you start cutting more programs in this bill, it's going to make it all that much harder to get votes. If you want severe cuts, you have to do it in a budgetary bill that covers the discretionary and mandatory spending programs. And you need 60 votes to pass that.
In Senate?
In the Senate. So tell me, where does Trump get 60 votes from to do significant cuts to balance the deficit immediately?
He doesn't have enough support in the Senate to do that.
He's not even close.
No.
So that
like
practically,
majority.
That practically is not an option.
Yeah.
as much as you may want it, Massey, Senator Paul, are all complaining because there's not enough spending cuts, but yet they never
And Johnson,
indicate.
yeah.
They never indicate where Trump can get the votes from.
Because he can't.
He can't. It's just not there in any reality that I'm aware of.
No. I think that's why
somebody to point me out one where it's there is, but I have not heard anybody even try to suggest it.
I think that's why he's also I had a thought. Where'd it go? I swear.
Never
mind. I might come back up with it.
Rand Paul.
Or Johnson.
Spending cuts.
Shit.
Nope.
It was
nothing.
there.
Okay. It'll come
Not right
back.
now. I know. Always does. In the most inopportune moment as well.
Yeah. I thought it would be, I guess, instructive to take a look at Trump's 2017 bill briefly. It was called the Tax Cuts and Jobs Act, TCJA, 2017. It promised long-term economic growth by slashing the corporate rate from 35 to 21%. So what was the result of the tax cuts? Also, don't forget, he cut his first year or two, he cut federal regulations by about 1/3, which is a pretty huge cut in regulations. So he had tax cuts and regulation cuts. The result, the evidence is in corporate profits soared. Now, some people were disappointed because the hope was that corporations would use more of this to increase wages. And they didn't. They, started increasing their stock buybacks, which actually does go to the employees, because for most large corporations, employees hold a chunk of the stock in their retirement plans or pension plans, whatever. And so the stock buybacks are a way, in essence, of, even though it goes to shareholders, a big chunk of that is usually employees as well. Another thing about wage hikes is, if you hike a person's wages by 20%, it's not just that. It's that, one, if business slows, you can't reduce that. So it makes you more prone to having to lay them off. Increases the risk of having to lay them off. Two, your other taxes increase.
Clay, would you rather make $80,000 or $100,000?
That's pretty obvious.
I'm talking about income tax, though. What is the point where what you're making is taxed to the point where you're bringing home less?
Well, you don't actually bring home less money. It's just the percentage that you bring home drops. So if at $80,000, if I'm in a 20% bracket, I pay $16,000 in taxes. So I bring home 80 cents on the dollar. If I make $100,000 and I move up to a 30% tax bracket, I bring home 70 cents on the dollar. So I'm still bringing home more money, but as a percentage of my total income, it drops.
Okay.
So, but there was the risk to corporations. So a lot of people complain because employees didn't get as much money as they were hoping. But that's not to say that there wasn't wage growth in this era. Wage growth nearly doubled in 2018 and 2019 after the tax cuts took effect. The wage growth went from 2.5% a year to right under 5% for 2019, pre-COVID. So employees did see a pretty significant increase in wages. With the overage, one, going into some expansion, and two, stock buybacks. Business investment, that expansion, creating new jobs, spiked after being flat in 2015, 2016. It went from 5.1 trillion to 6.2 in 2019, continued soaring after COVID. And that's the thing, once a company has a significant tax cut, they just don't all run out and start a new factory. They start planning. They have to start looking at sites. They do an analysis of the market. They're looking at what other markets do they want to be in. So it takes a couple of years. Once they start being confident that this revenue stream is coming in, is increasing, it takes them a year, 2 years, 3 years to figure out what to spend it on, where to spend it. So, even after COVID, you saw business investment continuing to rise. Obviously, it crashed during the COVID year. GDP, remember Obama talking about the new normal? Well, it went from, 1.8% in 2016, the third quarter, to over 5% annualized for the second quarter of 2018. So nearly tripled. This was before the Fed started hiking rates. So you can say, yes, the economy responded extremely favorably to tax cuts on income and capital and regulatory cuts. They go together hand in hand. And people say, well, Trump increased the debt. Well, actually, relative to the economy, 2017, 2018, 2019, the debt to GDP ratio stayed pretty constant at about 104 to 105%. Now, when COVID hit, revenues crashed. They did the stimulus. Yes, that spiked the debt. But I really don't necessarily hold Trump liable for that, or Biden walking into that hole for the first year. I hold Trump liable for the 3 years before. I hold Biden liable for the 3 years after.
Would it not be helpful if we could go back to pre-COVID spending?
A lot of people have suggested that, but it would still be a huge cut. Most people don't realize how much Biden increased spending to federal agencies.
Oh, muy vey.
So that would be a sizable cut, but that would just about eliminate the deficit. And that's only 5 years ago. So, in short, after Trump cut taxes, cut regulations, inflation was low. It was 1.8% in 2018, 2.2% in 2019, 2.4 maybe. GDP grew far more rapidly. And most interesting is that poverty fell. The total number in poverty fell from 27% of the population in 2016 to 23% in 2019. That's only in 3 years. Fell 4% in 3 years. Income inequality was reduced for the first time in 40 years since Reagan. The lowest quartile gained 18.2% in income. The upper quartile gained 16%.
Wow.
So that was the first time that the lowest quartile had gained more than the upper quartile. And part of the thing, and I've already alluded to this, is that many in Congress were planning on those tax cuts expiring this year, and they talk about, increasing the deficit. Well, what they're, when they talk about the deficit increasing, what they're really talking about is increasing your taxes, giving you a tax hike. For a single taxpayer with taxable income of about $50,000, $60,000, you would pay 17% more in taxes. For those making over $5 million, they would pay about 2% more. So, I kind of laugh when some people argue that the tax cuts, gave a bigger benefit to the rich. Well, when they say that the average household saved $6,000 in taxes, millionaires save $75,000. I'm like, well, yeah, because they pay $1 million a year in taxes.
Exactly.
So, but as far as a percentage of income, most of the cuts went to the middle class. So, anybody have any other questions? All right. Got to remember what all I need to do here.
Sorry, I was crunching ice.
That's okay.
So I was muted.
I'm sitting here thinking, this actually probably would be a good stopping point, because some of this detail I might need a little bit more time on, so might save this for Sunday night, next Sunday night.
Okay.
And so we may do that.
Well, let's do that. There's the whole Karen Reed thing. It was a big day for old Karen today and the whole trial. And we want you guys.
And I know a lot of our folks have, been following that closely.
Yeah. So let's wrap this up, finish it on Sunday. And if you guys have any questions that you want to ask about the big, beautiful omnibus bill, please write those down and let us know either before Sunday or on Sunday. We're at moffatonmoney@gmail or moffatonmoney@gmail.com, or on Twitter at moffatonmoney, or X, excuse me. And of course, YouTube at Moffat on Money.
All right. So we'll just stop there. I appreciate y'all joining us tonight. And we'll look forward to seeing you Sunday night, bright and early. Same time, same station.
It's 7 p.m. bright and early. Sounds good. We'll see you guys then.
All right.
Have a great night.
Appreciate it.
Bye-bye.
Our time is up. We thank you for yours. Good night, y'all.